All eyes are on the Fed and the market is volatile. In this episode, we'll take a look at how the Fed's outlook affects the bond market and provide insights as the Fed prepares for what could be its first rate cut by the end of the year. But first, let's review the process so we have a better understanding of what the Fed funds rate is and why it's important. So by now, you've probably become familiar with a volatile trend in the market relative to the Fed's outlook and their adjustments of the interest rates. So simply stated, the Federal Reserve decides what the Fed funds rate is in order to hopefully achieve their stated goals for the economy. The Fed funds rate is the rate set by the Federal Reserve for banks to lend to each other overnight. So these rates have a direct impact on various sectors of the economy. So obviously, if the Fed Reserve increases those interest rates, well, banks in turn are going to increase the interest rates that they have for consumer credit, like loans and credit cards. As that increases, hopefully that reduces consumer spending. The reduced spending encourages companies to lower prices so that they can attract purchasers. And this is a normal part of the economic cycle. So adjusting Fed funds rate is just one of the tools that the Fed actually has in their toolbox to help maintain a healthy economy. For example, tamping inflation, or if the economy is struggling to get started, they can lower the inflation or the interest rates to stimulate spending. It's no secret that bonds have struggled in recent years due to inflation and high interest rates. Bonds are particularly sensitive to interest rates since when interest rates go up, the price of bonds that are currently held due to them having a lower interest rate actually fall. So when rates jumped in 2022 due to inflation and the rapid Fed rate hikes, bonds fell into a bear market. However, they then stabilized and somewhat rebounded in 2023. Today, many of the factors that have driven bond returns are improving. Over the next few minutes, we're going to cover some insights into the bond market and why it's important to maintain portfolio diversification in the months and years to come. First, this chart shows the performance of different bond market sectors each year, and we call this a quilt chart. Each column is actually a different year with bond market sectors ordered from best performing at the top to the worst performing at the bottom. If you go to the far right, you can see that the Bloomberg U.S. Aggregate Bond Index is now flat on the year after struggling through April. And that's because we had inflation that was worse than expected the first few months of the year, and that pushed the bond prices lower. However, there are now signs that inflation is improving. The latest Consumer Price Index report, for instance, showed that the headline CPI was unchanged in May for the first time since July 2022. Certain areas like housing prices remain stubborn, but removing housing prices from core CPI results in a year-over-year inflation rate of only 1.9%. Of course, improving inflation does not mean that prices will actually fall for most goods and services we buy, but this is still positive for markets because it means we are slowly returning to a more normal environment, especially once the Fed begins cutting rates. And for this reason, other parts of the fixed income market have also improved, including investment grade and high yield bonds. Next, this chart shows the Fed funds rate, and if you look towards the end, that tail you see there is the Fed's rate cut projections. Their latest meeting resulted in no change to policy rates, but the committee did revise the forecast from 3 cuts this year to only 1. And the remaining 2 cuts were really just pushed back into 2025. These projections are very much the result of the worse than expected inflation that we had earlier this year. Now, the market still seems to believe that 2 rate cuts could be possible, with the first one beginning in September or November. And regardless of whether it's 1 cut or 2, the point is that we're on track for the Fed to begin reversing its policy moves of the past 2 years. And if and when this happens, it could help to support bond prices, which benefit when rates are stable and falling. Of course, the Fed's projections are subject to change, and a lot could happen between now and year end. Still, this is positive for long-term investors since it means that portfolio diversification is really more important than before. Historically, bonds have helped to balance portfolios because they tend to move in a direction that's opposite to stocks. And when the economy and the stock market stumble, interest rates usually fall, and that helps to boost bond prices. Now, this pattern has not played out as much in the past few years since recent volatility has really been the result of inflation, and that hurts bond prices. That's why you can see in this chart in 2022, the bond market experienced a dramatic bear market. Its intra-year max drawdown was 17%. Now, if inflation truly is improving, at least at that macro level, and the Fed does cut rates, there could be a tailwind for bonds. Additionally, right now the yields are really attractive. They're far more attractive than they've been at any other time since the 2008 global financial crisis. So for both long-term investors and those who need income from their portfolio, including retirees, it's more important than ever to stay diversified across both stocks and bonds. Now, we've only begun to scratch the surface on this topic, and I hope you have found these insights helpful. If so, please like the video and subscribe for future updates. If you would like more information about how you can incorporate bonds or bond funds into your investment strategy, then please visit my website at milliganwealth.com. Also, feel free to reach out to me anytime to discuss these topics and more in detail. I look forward to hearing from you.